Hello everyone, I'm Michelle Yuchao. Many investors interpret the US stock market through the lens of the Chinese market. However, those two markets operate completely differently. In China, if you buy a stock listed on the Shanghai Stock Exchange, your order can only be executed there. This is what we call a centralized architecture, where custody and trading are bound together. In the US, it is completely different. You might think you are buying a stock listed on NYSE or listed on Nasdaq, but your order might not be executed there. The complexity here is like moving from a one-way street to a multi-layered highway. Today we will break down the myths by explaining details of UTP and TRF. First, let's talk about the cornerstone of the US market structure, the unlisted trading privileges plan. It is much easier than it seems. Remember the following: the listing venue is not necessarily the trading venue. In the US, there are 18 securities exchanges. The UTP plan connects them all together. Look at it this way: listed on Nasdaq doesn't mean its trading is locked by Nasdaq. Its shares can be traded on any US exchanges. This creates an extremely competitive environment. The impact is who has the strongest liquidity and lowest spread wins the orders. Let's see what Nasdaq's competitive edge is. The Nasdaq Group operates the Nasdaq stock market as well as the Boston and Philadelphia stock exchanges, actively participating in the competitive landscape. This means Nasdaq isn't just an exchange, it has built a wide and fast highway network in the US market. While UTP connects the exchanges, the secret winning sauce in the US market is the capability to address the invisible traffic. More than 50% of the trade volume doesn't take place on exchanges. Instead, the trades can also happen off-exchange or in dark pools. If no one had ever managed this massive flow of capital, the market would have been in chaos. So the US regulator mandates the creation of trade reporting facilities. All off-exchange data must be reported through TRF. The question is, who is capable of handling this massive data through billions of messages per second? Currently, there are 3 core TRF processing centers in the US. Nasdaq operates 2 of them, the Carteret Center and the Chicago Center, while the NYSE operates the remaining one. This isn't just the advantage of 2-to-1. In terms of market share for data processing, Nasdaq's 2 TRF systems supported by are able to dominate the market. According to the data from the 10 trading days prior to December 5, 2025, 70.10% of Nasdaq-listed stocks were processed through Nasdaq systems. Remarkably, 53.5% of NYSE-listed stocks were also processed through Nasdaq systems. You could say that this gigantic data iceberg is mainly with Nasdaq. To help us better understand this, let's look at the following example of Chinese ADRs. While most of them are listed on Nasdaq, they can actually be traded anywhere because of UTP protocol. Let's see how phenomenal the situation is. Take PDD as an example. With reference to the October 2025 data, when we combine Nasdaq exchange trading volume with off-exchange volume captured by Nasdaq's TRF, we found that Nasdaq's processed 70.62% share of the total volume. This means that for every 10 traded shares of PDD, 7 were processed through Nasdaq. For many popular tech stocks and Chinese ADRs, Nasdaq literally handles the largest portion of the market liquidity. This means that whether your order is placed through exchange or sent to a dark pool, it is highly likely that Nasdaq is serving you. Nasdaq is not just the listing hub for their stocks, it's also the steward of their daily trading volume. From UTP to TRF system, the US market is made competitive and transparent. Nasdaq is the enabler of the structure. Through technology and knowing what our client wants, Nasdaq connects the dots and provides investors the market liquidity. I'm Michelle Yuchao. See you next time.